Chris Lapointe had actually mentioned that he'd watched the last time when Darth Chris came on and I was on last time, that he'd at least seen part of that SoFi Weekly.
Wow.
So the CFO has at least
Now you can ring the bell.
Watched. There you go.
That's cool, man. That's awesome.
So at least part of that episode he had watched.
We're live, SoFi Weekly. Me, Tannor, Tevis, Riley, and Chris Hoeger.
Maybe introductions to Chris.
I'm a
job.
chemical engineer. I also write for Seeking Alpha, and I spend way too much time poring over SoFi investor relations and 10Qs.
And he's going to be telling about how he had a conversation with Chris Lapointe, the CFO of SoFi, everything about stock-based compensation and how it might not be as bad.
We had this Twitter back and forth trying to kind of figure out some of this stock-based compensation stuff and how different parts of it are expensed. Chris Lapointe the next day came and had like this long thread of like 8 different tweets, clarified some of the stuff. They had gotten back to me and said, would you want to do a quick 15-minute interview with our CFO, Chris Lapointe? The call was off the record, and I have to get permission to talk about specific things, but he was really down to earth, really intelligent, well-spoken. To give a little bit of background, there's 3 different types of stock-based compensation that they can give to employees, right? There's RSUs, which are restricted stock units. There's performance stock units, which are PSUs, and then there's stock options. So for the purposes of our conversation, we're going to ignore stock options. Stock-based compensation is in orange, revenue of SoFi is in blue, and then the line at the top is the stock-based compensation as a percentage of revenue. So they came public in second quarter of 2021, starting in basically fourth quarter of 2021, and all the way through the rest of it, they've had between $77 and $80 million of SBC. So that's been pretty consistent. 1/3 of that, so about 25 to 30 million, is from the performance stock units, and about 50 million of it is from the restricted stock units. So restricted stock units are given to employees, and the only requirement that those employees have to fulfill in order to be granted those shares is time at the company. So if they're still active when those shares are vesting, then they'll receive those stock. Performance stock units have other performance metrics that are associated with them. And Tevis covered this also in one of his videos that he did earlier this week. But for the PSUs, the performance stock units, they are tied to SoFi's stock price. So they gave some of them to Anthony Noto, a bunch more to the rest of the executive team and the rest of the employees at SoFi in third quarter of 2021. The restrictions on those are that the stock price has to get to $25 in order for them to get 1/3 of it, to $35 for them to get the second third, and then the final third gets awarded if it hits $45. So that stock price target has to be hit before June 1st, 2026. So in the next 3 years, in order for them to get all of it, the stock would have to almost 10x from where it's at right now, right? In order for them to get any of it at all, a 90-day average, we have to trade above $25 a share.
So 5x. In the future, SoFi would continue to give RSUs, which naturally vest over time, but the performance-based units, Chris was mentioning in his article, they're likely not to return. That, with the combination of the revenue continuously going up and the total SBC offered going down, as a percentage of revenue, is going to come down very quickly over the next couple of years, number one. And then number two, the massive variance in terms of the PSU payouts, if it hit or if it didn't hit. Let's say SoFi hit $45 by 2026, Noto would be looking at almost 300 million. If that doesn't hit, all of those PSUs essentially expire worthless. The amount lost to his net worth would be absolutely massive. And so it's a gigantic risk for a lot of these executives because a lot of their compensation is PSUs.
The basic idea behind this table is that executive incentives are really aligned with investor incentives. And the other thing is that everyday employees actually got more than half of the PSUs. So there were 23 million PSUs granted total. 13 million of those went to rank and file employees, not to the executive team. More than half of them went to normal employees. So there's lots of employees who have this exact same incentive and will benefit if investors benefit. For the last year and a half, every single quarter, we've been dragged down by $30 million on our bottom line. So that ends up being negative GAAP income that does absolutely nothing if we don't get above $25 in 3 years, if the share price doesn't get up there. $30 million every quarter is going to something that's going to cause zero dilution for shareholders and going to actually cost the company no cash, no real money. Like it's just monopoly money on a spreadsheet somewhere. But it's $30 million every single quarter that's dragging on their bottom line that only is actually worth something if they get to $25 a share. And to be clear, 50 million, which is well over half, is in RSUs that as long as people stay with the company will vest. If you look at the fair value of those RSUs versus the shares, the fair value for those shares are all up in like the $20 per share range. These RSUs are still vesting now, and they're still still being expensed now. A portion of them are still being expensed as if the stock price was still like $20 a share. A lot of people just don't understand. They see this SBC and they think it's 20% of revenue that they're just giving out in stock. The people who get on Twitter and say, he's making 3 times as much as the CEO of JP Morgan Chase, and that's ridiculous. On the 10K, it talks about how that he earned, quote unquote, $100 million in 2021, but 94 million of that, which you can see on your screen right here, is in PSUs. If we don't get to $25 a share before 2026, he actually got $0 from that $94 million that was reported as income.
The other executives have a fairly even RSU PSU split, but Anthony Noto's split is absolutely insane. That will all disappear if the targets are not hit. He very, 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 very much more so than every other executive has skin in the game because of the disproportionate weighting in performance units as opposed to restricted ones.
And then think about how influential it is whenever he's purchasing shares on top of that with his own money. If he were to just work on the stock alone, he would already have so much skin in the game, but he's also doubling it up to also try to get that reward with his own money. We want them to have this money. Tesla, probably the biggest example that I could think of, where Elon Musk had massive targets to hit around 2019 and then into COVID, where if he were to hit all of those targets, he would become the richest man in the world. Obviously, he gets rewarded. And because the stock is 10 or 20x throughout that time, no one complains because they are also getting rich during that time frame.
Chris, real quick, in your article, you say that there is a limit that SoFi can dilute shareholders.
Everybody voted on this who's a shareholder. If you did vote in like July of 2022, you can find it's an SEC filing, says that the maximum amount that SoFi can award in compensation every single year is 5% of the total outstanding shares on December 31st of the year before. It won't ever actually be 5% because there's churn at any company, right? The only way that it would be 5% is if every employee they gave SBC to stayed on through the entirety of vesting all of their shares, which doesn't happen. So to date, about 1/3 of the RSUs that they've granted haven't been awarded. They've been forfeited because people move on and go to different opportunities and other reasons, right? I think it's probably going to be somewhere closer to 2.8 to 3%, at least in the next few years, which isn't nothing, right? Like investors should be aware that that dilution is happening. Dilution is important to realize, but if you're paying 2.8% dilution in order to get 50% growth, that seems like a reasonable investment to me, which is why I'm continuing to add to my position, right? Like I'm DCAing into SoFi every single week.
One of the things that surprised me the most in that article, Chris, was that if the tranches are not hit, there's no clawbacks or no way to offset that expense. And that's a huge risk taken by the company. Number one, to determine the total amount of PSUs that they want to issue. And number two, to determine what those tranches are. Like that Monte Carlo simulation is really important because it basically is determining whether we are going to issue them versus not at all.
Yeah, so part of the expense, and this is the reason that they do this Monte Carlo simulation, is that mathematically speaking, right, it takes into account the possibility that the stock could never reach those. And that's taken into account to the fair value of the PSUs. Total, the PSUs are costing the company $220 million, and you can't get that back. So if in 2026 we're at $24.99 and they never vested, or even if we're at $5, right? Like whatever the stock price is, as long as it's below 25, none of those vest. They don't cause any dilution. And that $220 million was literally just monopoly money that just comes off the earnings. It comes off the bottom line.
So they have until 2026 to hit the tranches, but they have until Q1 24 to actually expense the $220 million. Is that their decision from the Monte Carlo simulation, or can they extend that to 2026? So it's less of a hit on the financials.
This was the most confusing part, and this is the reason that I talked to Chris Lapointe, is because I tried to figure this out on my own and I couldn't. The way that that money is broken up, so you've got like $220 million, and it's broken up into 3 tranches, one for the $25 stocks, one for the $35 target, and one for the $45 target. And each of those are given a servicing period, is what they call it. And so it's a period over which those are going to be expensed. It has to do with the probability that the stock eventually hits that price. All 3 tranches are being expensed right now, but eventually at some point the $25 tranche will roll off. SoFi doesn't give the exact timeline for these. My own kind of digging into the numbers makes me think that some of them might start to roll off already or might have already rolled off in Q4, and a significant portion, if not all of them, will have rolled off by Q1 of 2023. So like a third of the SBC from the PSUs will be gone, and then a little bit longer period later, the $35 ones will roll off, and then finally by the first quarter of 2024, all of it will have been expensed and will roll off.
The servicing period, my understanding is from what you just said, that's determined when the PSUs are granted. Can that servicing period be changed? Because what I'm thinking of is if they can extend the servicing period or the expense out to 26, then that looks way better on our numbers as opposed to 24.
They can't. So this is just part of GAAP accounting, right? That's just the way that you do it. You run a simulation. There's different simulations you can do, Monte Carlo, or there's like something skulls or whatever. Anyway, there's different scenarios you can run. But yeah, that's the one. But once you run it and once you've established the servicing periods are determined by this Monte Carlo method.
Great article though. Like
Yeah,
seriously, it
fantastic.
was so well written. It was like super easy to understand, and it clarified so many points that I didn't really understood at all. So it was amazing. SoFi 2 days ago posted a listing for a senior exec managing tech team for building out credit card. It looks like they're hiring people for credit card development. I don't know what that's going to look. Just know that they're hiring for that. They're hiring a ton of fraud people. They're expecting to grow really fast, and they're trying to get ahead of the curve because fraud is kind of like an S curve with fintech companies. It comes out of nowhere. They're hiring a ton of fraud, but that is good because it just means that SoFi expects that their members are going to be growing really fast, really quickly.
So this is something that I didn't understand. Whenever I was reading up about Galileo, we had partnered with Datavisor, which is the market leader in fraud detection for online banking. So if Galileo is using that, I would assume that in some sort of space that SoFi is using this. So why are we hiring people for our own division of fraud if we also are subcontracting that out in a way?
Datavisor does a lot more, and they focus specifically on like super complex like machine learning stuff.
Fraud management for financial services. This is just one of their things. This is just specifically in banking, helping combat money laundering, spot call center fraud, secure peer-to-peer transactions. They don't just deal in one section. They deal in literally every fraud type in banking, from ACH to, checks and everything, even application fraud. So whenever people are actually signing up, I just find it weird that we have such a close relationship with them. And then in the next same breath, we're sort of doing it ourselves. So I don't understand. I don't know if that's necessarily a big point.
No, I think Galileo is very like niche when it comes to our fraud because the tools that Galileo has built are only like supplementing the products that they provide to other people. So like Robinhood uses our debit card issuing. So Galileo has made like a tool around that to focus on fraud in that area. But Datavisor, yeah, they have clients like all over the place. Anyway, the main takeaway is hiring more fraud means that we're just going to have more members, and SoFi is dead set on growing like at all costs because that's the biggest risk is when you have more members, it becomes it's like an S curve for fraud. It gets harder and harder to solve problems. So it's good. It's good news.
Do we want to talk about APY changes?
Noto just confirmed on Twitter that the 3.75 is going to apply for self-employed individuals.
I can't make this any bigger. I apologize. I tried to make it bigger. It's not getting any bigger, so I apologize.
That is what I said.
Yeah, okay, just throw the screen up. I knew it was coming. So this is Samsung Money by SoFi. They are now allowing that our APY will be through your Samsung Money account by SoFi. I immediately thought, okay, so we're actually being a bank sponsor. We can finally take them on as a client through the deposits. Now, the more I read about this actual relationship with Samsung Money, it doesn't even feel like a Samsung product at all. I don't know how this works. I don't know. It's just this big product that we keep showing off, or Samsung is showing off. But then if you actually want customer support, you don't go to Samsung, you go to SoFi. Like all the emails are SoFi domains and everything. So I don't know how, is it our product or is it Samsung's product? I have no idea. Zachary Perret, he's the CEO of Plaid. Plaid was trying to be acquired by Visa back in 2020. So obviously they've grown a ton because that was right before a massive fintech boom. But back then Visa tried to acquire them for $5.3 billion. Some of these things are, oh, sorry. I can't seem to get it up. I gotta stop. I gotta stop. This is the fintech predictions. Now, there are a bunch on here. Some of them just full-on regulatory manners, others in the crypto space. But I want to talk about the ones that are going to affect SoFi directly and not just fintech in general. The pace of new fintech startup creations will be substantially slower for those that require partner banks or banking as a service providers. If you guys know anything about Technisys, he's talking directly to us. Recovery in the pace of fintech formation expected in late 2023 or early 2024. The slowdown in new fintech formations will be made up by the continued push for big tech, retail, e-commerce, and the banks themselves to launch new wallets, lending products, and fintech tools. In Chris Lapointe's latest interview, the one that he did with Credit Suisse, he was actually talking about how they're in talks, not with small players anymore, but with the big guys, with consumer platforms and big banking institutions. And then they're also looking to launch products like, lending products, rewards, all these things that would fit the bill for exactly what the Plaid CEO is saying. However, there is going to be a slowdown overall, right? So
just on that point, like the fact that there's going to be a fintech slowdown, it probably hurts Galileo revenue. But at the same time, I also think that it's good for SoFi in general because now we're going to have an even bigger first mover advantage. I don't know of any other fintechs that have applied for a bank charter, keeping a pulse on
did you hear
everything.
about that crazy Noto prediction where he said there's not going to be a new bank
Yeah.
charter for a decade?
For like the
They won't
next
even get
decade,
one if they
right?
do apply.
But the thing is that SoFi is already so far ahead that if there's not going to be another wave of new fintech startups until the end of 2023, 2024, like at that point, we'll have been gap profitable. We'll have had this first mover advantage. And then as they come online, hopefully at that point, right, we've got Technisys and Galileo lined up where it's a package deal that we can sell to all these new fintechs that are going to be coming online at that point, right? Short term, it's probably not the best, but actually long term, that's probably a good thing.
They actually upgraded a lot of fintechs saying that because there's not going to be a lot of new fintechs, the actual amount of market share that the existing ones are going to capture is actually going to go up because it's a harder space to actually try to enter right now. Profitability will be the primary focus for late stage fintech. This will lead to a focus on slower, sustainable growth and products that deliver short-term returns. Initiatives like internationalization and new vertical expansion will move slowly or be paused altogether. I immediately think of SoFi Singapore and SoFi UAE.
They had this plan in place back when Noto joined the company in 2018 of this like 70-30 split, right? So the idea is that for every incremental dollar that SoFi makes, they want to reinvest 70 cents of that back into the business and then drop 30 cents to the bottom line. They've been super consistent during 2020 and 2021 when it was like grow your top line as fast as possible, growth at all costs. SoFi didn't waver from their plan. And now we've completely shifted, right? And it's gone from growth at all costs to profitability at all costs and cut all your costs and do everything else. But SoFi hasn't shifted their mentality. That's the type of management I want to be invested in. They have the idea of exactly what they want SoFi to become. They have been executing incredibly on that vision, and they're not modifying their vision just because the market is telling them something else.
He said loan volumes will remain depressed. Lenders will focus on efficiency. After years of high volume lending, lenders will retranche, meaning slow down their spending, and expect to see an increase in digitalization as lenders hunker down and focus on cost efficiency in 2023. Serving and loss mitigation will be a core focus for lenders. With forbearance and borrower assistance coming to an end, delinquencies will return and even surpass pre-COVID rates. We'll see a deeper focus on risk management and more use of data and monitoring loans.
We actually saw this yesterday. Lending Club announced that they were cutting 14% of their staff.
He also says B2B fintech companies will continue to ramp up efforts to sell to banks, Galileo, and their focus on B2B companies rather than B2C, that big switch last year. Over the last year, banks have been quite receptive to B2B fintechs as they look for products to accelerate their digital roadmaps. And it just seems like Anthony Noto keeps placing himself always in front of the newest product or the thing that's going to be actually the accelerant that year. Whenever student loans were closing down, we went to personal loans. If personal loans start to slow down, then we'll go to B2B. Now we're focusing on the big ones that will survive, the banks, a lot of the actual, embedded finance companies. And
I was interested by that thread, but I wasn't too impressed by too many of the insights from the Plaid founder because we've heard some of the main ones that pertain to SoFi from different talks at like the City Conference, the GS Conference over the past couple of months from Anthony Noto and the executive team, because they're just on top of it in terms of correctly identifying the same trends that the Plaid CEO is also identifying for the upcoming year.
The only thing that I think is different is that, Chris, you said that Lending Club was...
They're having a 14% riff.
And that was the same day that Anthony Noto came out and said they're hiring. And by the way, Zachary Perret and Anthony Noto are very close friends. They talk a lot. They have business partnerships and everything. So
I think he's been on Anthony Noto's podcast.
Right, on
Their
Who Dares
podcast,
Wins as
yep.
well. So obviously they know each other. I felt like he was talking directly to SoFi in some of those comments, but I don't know if that necessarily that's the way that Anthony Noto is playing this right now. It doesn't seem like we are being extremely risk adverse right now.
Like I said, I think that they have their pathway forward and they're not letting the macro environment dictate what the company does. I think they're doing what they think is best for the company. So I do think there's going to be plenty of demand from people who want loans. That demand isn't going away. Lending Club also said they pre-released Q4 earnings, and in part of that said that they only did $2.5 billion in originations. That's down like 30% quarter over quarter. So last quarter they were at like $3.5 billion. Now they're at $2.5 billion. I would guess the vast majority of that $1 billion difference is in their marketplace, which it'll be really interesting to see how that affects SoFi, because there is a limit to how much SoFi can originate if they can't continue to sell loans off of their balance sheet. Eventually they will run out of capital that they can lend out.
What are your predictions for Q4? Have you opened up about that? What are some of the standout statistics that you want to see this quarter?
Historically, Q4 has been one of our better quarters for membership growth. I think the reason for that is because it coincides with the NFL season. And so we get a lot more impressions just generally. I know that Riley and Tevis did a video on this earlier. I would tend to agree with them that I think we'll see more than 500,000 members. They said last quarter that they might pull back on marketing, that they're happy with 400,000 or more. My gut feeling is that we'll get a little more than that. What I'm really looking for, so how much we're going to sell, I anticipate guided for 6 to 7 months. If there's really pullback from whole loan buyers and in the securitization markets, they're not going to sell loans at a loss just to sell loans so that they can originate new ones, which means that you could start to see lending growth tail off a little bit until those investors come back. One thing that is a tailwind for SoFi is the fact that we've actually been raising our rates faster than competitors. Lending Club talks about this a lot. They say the Fed raises rates, and then a month or two later, credit card companies raise their rates, and then a month or two after that, then we can raise our personal loan rates. And so they lag the Fed. And their CEO just was on a podcast the other week and reiterated that's what they're doing. If you look at SoFi's numbers, they're not doing that. They're actually front running the Fed. So we are raising the APR on our personal loans faster than we're raising the APY on our deposits, and faster than the Fed is actually hiking rates. So
why do you think that is? What's the strategy behind that?
The fact that we are gaining so many members every single quarter makes it so that we have this much bigger pool of borrowers to draw from. The other thing that's really bullish about that is we're still growing our originations, and we are raising our coupons faster than competitors. And at the same time, we're keeping the quality of our borrower the exact same. So if you look at FICO scores and if you look at average salaries, they're the same. When I say their execution has been really, really great, like almost flawless in a lot of ways, it's because of stuff like that. At some point, they will run out of capital. You can't keep lending forever. At this point, there's still billions of dollars that we could go into. But for example, last quarter, we grew our loan book by 2 or 3 billion. We can only do that for 1 or 2 more quarters before we hit like a hard stop, and we couldn't keep growing at that same rate. I want to see that cross-sell is still going up. I want to see the memberships going up. I wish they gave more clarity on the technology segment. There's so few numbers in the 10Q to be able to actually pull out who these clients are, how they're monetizing the revenue. So it's really hard, and unfortunately we don't get a lot of detail there. And then on the financial services side, I'll be looking in Q1 to see kind of what an effect options trading has, and hopefully they'll get out level 1 options before then also to help out with that. Those are kind of the things right now that I'm looking at.
So we were trading in the $4 to $4.80 range for a while, and we broke out, I guess, because of the CPI rally. I know it's hard to speculate, but do you think that's a little bit of a bottom we have formed? Do you think it could possibly go back under 4?
Hate to talk about where the stock is going in the near term because I suck at it. I think it was criminal. Like I can't imagine looking at SoFi the company and the valuation of it and having it be at $4.20 and thinking I should sell this company. That just seems so irrational to me. Based on fundamentals, that if you ask me, should this be the bottom? I would say yes. If you ask me, is it the bottom? I would say I have no clue.
Okay, so this is NerdWallet. They get about 19 million monthly unique users to their website. They just put out last week their best of 2023. I'm just searching for SoFi here. It comes up 7 times. Last year, it came up twice. Best checking account, best for high interest, best for no monthly fees, best for overdraft fee avoidance, the best checking and saving account combo. Credit cards, we didn't show up. Best insurance, best investing, obviously not. We're probably on the worst investing platform of 2023. Mortgage lenders, that's something that we need to fix. Personal loans, best for good to excellent credit, and the best online personal loan in general, which is, I think, the most exciting award that we've gotten from NerdWallet. Obviously, this is one blog.
There was
Yeah,
a
go ahead.
question if one of these rankings are paid for. They are unpaid for. So if you go on NerdWallet's FAQ, they specifically say no, these are independent and nobody is paid in order to get these rankings. So these are independent third party.
NerdWallet's whole business is to get affiliate income. So obviously, whenever people go through NerdWallet and create membership, we are paying NerdWallet to get those. But that's with every single bank and every single fintech that's also on that list. So we don't stand out in any
revenue, right?
unique way.
Can we talk about Frank?
I'll bring up this article here if you guys.
Tevis had a good point. He says legacy banks name their newest products after old white men. Marcus.
They're named after the founders.
Well, Frank wasn't named by JP Morgan. It was.
How else are you going to
founded by
appease the
somebody else.
people that have been there for decades?
Yeah, why are they all named just names? Dave, Marcus, Frank. There's way too many of them.
I love the argument that we've heard in 2022 is all these big traditional banks, they can just compete with SoFi because they have endless pockets. And we're seeing these big banks fail in so many tech-oriented projects.
This is Frank, a student loan refinancing company. If I remember correctly, they had 4 million, nearly 4 million fake accounts out of the 5 million that they had total.
So I actually don't think it was a student loan company, but like it was a financial aid. So like you could go on and you could get help filling out your FAFSA and anything else you needed help with as a student. But I don't think they were specifically a lender.
They closed down. This was one of JP Morgan's things. They're suing the founders to the end of the earth. Frank is gone now. Frank stepped down. Marcus is stepping down, not completely, but from the consumer facing side, that's not extremely high end. So I know that they couldn't actually find a road to profitability. However, they did find some successes in deposits and these sorts of things. This is what IP Banking Research had talked about. But he said that because Marcus couldn't do it, it's a failing business model or something along these lines, even though like Lending Club is doing perfectly fine and SoFi will be doing perfectly fine.
I have one single question on Frank. Number one thing I found interesting about that was they found out months after the transaction closed, after they sent 400,000 emails and 70% bounced back, and they paid 175 million in 2021 to buy this company. Where was the due diligence? Can you imagine the layers of bureaucracy you would go through to buy a $175 million financial institution? And they didn't even test to see if the accounts were legit. That baffles me.
People get on our case for paying what we did for Technisys. At least it works. At least it's not fraud.
Legacy banks don't do due diligence. I don't think it's that they don't do due diligence. I think 2021 in general was a crazy funding environment. They probably just wanted to get deals done.
I mean, SBF got through how many years and how many VCs and how many financial backers. And
this was a great episode, Chris. Thank you for coming on and explaining everything about this article. I mean, this article kind of took us by storm this week. I think one thing we didn't talk about is that the fact that SoFi gave a retail investor 15 minutes of a very high level executive's time.
Again, I felt like it was his dollar waiting on my dime. The amount of money that was being spent on his salary during my 15-minute interview, but I do think the fact that they're willing to do that shows me that they actually do care. They knew I was a retail investor. They knew that I only write to retail investors. They did that because they care, and that's awesome.
Yeah, I just want them to come on the show. I mean, we already confirmed that they watch it, so just come, like the incremental from watching it to being in the chat to just come, it's just a link away. So
the other thing too is if we do get Noto on here, we will like legally not be able to say shit about the stock. So we'll literally just be asking him such good questions.
I mean, you can talk about the company, just not the stock. There's lots of questions publicly available.
What player are you in SoFi?
Are you the quarterback or are you? All right, everybody, we're out. We'll see you next week.
See y'all.
thanks, y'all.
Bye, guys.
Bye, guys.